Welcome to Checks and Balances. I'm Michael Vincent. This is James Blair, and this week we're joined by Matthew Harris, Director of Lighthouse Accounting, to talk interest deductibility and what it means for you.
Matt, I've missed you.
Hey, good to be back, Jimmy.
Good to have you back.
Thank you.
So today we're talking about interest deductibility. We've hit on it a couple of times in the past, but what we thought we'd do today is talk through some case studies, and then also it's kind of that phasing out is starting to hit people, so we thought we'd kind of tackle it today. So Matt, really quick recap, because we've tackled it a few times. Interest deductibility, what is it?
Yeah, so we have obviously done a brief podcast on this, but to really summarise what happened is the government came out of left field and pretty much surprised all property investors with the removal of interest deductions. So it's pretty well understood that if you borrow money to derive income, you can claim a deduction for the cost of borrowing that money.
Yeah, just like a business, cost comes against the profit, pay less tax.
Correct. And property investment, in my mind, is a business. It should be treated as such. Mindset's really important now in this complex world where it's harder to get debt, it's harder to buy properties. It is a business because it takes a business mindset. So for the government to do this and to basically come in and say, yes, you're in a business, but no, you can't have the cost for deriving assessable income as a deduction, it was pretty surprising.
Yeah, but it makes complete sense, right? Because if you can't build more houses, just tax them more.
It's how an economy grows.
Yep, that seems to be the approach of this government with property, that's for sure. They've tried to fix what's clearly a supply issue.
By dampening demand.
Yeah, by basically targeting demand through taxation and other measures.
Yep. And so the announcement comes out, people are like, this sucks, this is going to hit me. But because it's phased out over a period of time, it's not something where people have had to pay more tax immediately.
Yeah.
So it's been phased out over a period of time. Is that right?
Yeah, that's right. And I think to be fair, a lot of property investors aren't actually feeling the impact and probably haven't considered how much of an impact this is going to have on their cash flow, their portfolio, and basically the rate of return over time.
Yep. So I think when it comes for Lighthouse clients, like we've been having the conversation for a while, people know what's about to hit them. There's not going to be any surprises. But for those that maybe don't have that relationship with their accountant, you've got a kind of a case study that you're going to talk us through?
Yeah, absolutely. Should we rip into it?
Yeah, let's go.
Yeah, so just to illustrate, so you did right, our clients, they definitely know it's coming. Yeah. And we've been doing our best to soften the blow for them. But let's go through the numbers, right? So imagine I own a rental property already. It's not that hard to imagine because I do. And I get $700 a week, and I always work on 50 weeks. So assuming that obviously if it's vacant, you don't just have a 2 week a year, but if it's tenanted for 5 years and then it's vacant once over that 5 years, you can say 50 weeks on average. Say I'm getting $700 a week. That's going to give me income of $35,000.
Yep.
Then I'm going to have a whole lot of standard deductions that are really common to property investors. So you've got rates, you've got insurance, you've got repairs and maintenance, property management fees, legal fees, accounting fees, all deductible, and you've got interest. By far the biggest cost for a property investor because property investment businesses are debt funded. More so than any other business in New Zealand. So imagine I've got a $900,000 loan, which, if we're working on $1 million, maybe I've got 10% in, maybe it's worth 1.1, so I've got a little more. I'm paying 3%, so obviously that might not be current moving forward because we're moving into a higher interest rate.
Some people are still on them, and I think that's a really important point. I'm going to jump in, quickly. If people might not be feeling the full effect of this yet because they're still on those fixed rates and it's been phased out. There will be a double whammy if you are jumping interest cost and this gets completely phased out. Got to watch it.
Potentially a triple if we're talking interest-only periods as well, right?
Yeah.
Yeah, correct. And it's actually really perverse outcome where the cost of running your business increases, but your tax bill increases with it.
Yeah.
And a lot of conversations with our clients have been about charging market rent and making sure our rent is getting increased. Obviously, it's harder under this government now. You only get a couple, once a year basically to raise rents. But market rent's really important. But another perverse outcome is if I raise my rent, my tax bill increases as well. So you can't even, economically the numbers don't really work. So anyway, back to the example.
The house always wins.
Yeah. In this house is the government, and then there's no red on this table, or it's only red.
900K mortgage. We've got the list of expenses in there. What comes next?
Yeah, right. So we've got all rates, insurance, legal fees, all the common stuff, and then we've got interest, right? So 35K of rent, 3% on 900 grand is going to be $27,000 deduction.
Yep.
So you can see that most of the income is reduced by that deduction. You're left with a net profit of $2,600.
Yep.
To be honest, if you're a positively geared investor, you're doing pretty well.
Yeah.
In the low interest rate environment, a lot of people were, but we're going back to an environment where probably negative gearing is more common.
Yeah.
And the rate of return is probably judged more by the capital growth of the property over time.
Yeah.
Anyway, regardless, $2,600, you got about $850 tax bill.
Cool.
Totally
Palatable?
palatable. Yeah. Absolutely. I was going to use that word exactly. So, great. That's how it used to work. From 27 March 2021 onwards, and I have to be careful here because it's not all property investors. If you buy an in situ property, so that's a property that already exists in the housing stock in New Zealand,
Yep.
you no longer get an interest deduction.
At all.
At all. If you already owned it, it's getting phased out over time. So probably, we talked a little bit about our clients especially.
Yep.
This year we're doing the returns at the moment. 75% of the deduction is allowed for the March 23 year. So they haven't actually felt it. We're doing the 2022 years at the moment.
Yep.
Not a hell of a lot going on, but they're going to start to see it going forward. But that's if you already own the property. If you buy one after 27 March, you have zero interest deductibility.
Yeah.
Right? So basically, it's probably a podcast for another day, but if you buy new builds, still deductible.
Yep.
We've got a two-tier system for property investors, and I don't want to get into it, but if you've got a tax environment where you're treating two investors that pretty much could have the same situation, maybe they're mum and dads, they both have a full-time job, they've got two kids, and one buys a new build asset and one buys an in situ asset, and they totally different tax outcomes. I think there's something going a bit wrong in our tax system.
Yep.
Anyway, back to the example. So we use that very same example. We're earning the same rent. So our rent review period has not come up yet. So we haven't been able to do anything. We're still getting $700 a week, 35K. We've still got rates. We've still got insurance. We've still got repairs and maintenance. We've still got our property manager. And we've still got to pay our interest.
Yeah.
Because the bank's not going to say, hey, don't worry, guys, you can't deduct it. We're not going to charge
This
it.
one's on us.
Yeah. I don't think I've ever heard a bank say that. So I've still got those costs. So I'm still paying $27,000 of interest. But here is where it gets pretty hurtful, right? My tax bill was $850. My tax bill is now going to be $8,900. Yeah.
Jesus.
We are talking a significant out-of-pocket cost for a property investor. So let's think about a property investor situation. You're that mum and dad. You've got a fixed income.
Yep.
Your kids still have to have their school fees paid. You've still got to pay your home mortgage. You've still got to pay all your outgoings, groceries, everything else. And now you've got $8,900 that comes out of your pocket because you provided accommodation for another person.
Yeah, it's pretty crazy.
Yeah. At a probably, I might say, at a far cheaper cost than the government provides.
Yeah. And there's I think the real sort of loss there is that, treating property investors like the big bad wolf is a really easy out, right? Super easy to blame. You're allowed to hate property investors, but they actually provide a really necessary service in the economy for people who can't buy. Unfortunately, not everyone can buy a house. That sucks, but that's the way it is. There will always be demand for rent. The government aren't doing it. There needs to be public developers, public landlords, and it's mostly mum and dads. These aren't 40, 50, 60, property investment portfolios. It's mum and dad trying to get ahead, who've got one, maybe two properties, just trying to set themselves up. Yeah.
Yep.
Yeah. And if you extrapolate that over 10 years, that, $8,000 odd, it ends up being a lot of money. And in that example you've got as well, it's a 3% interest rate, right?
Correct.
So you think about what's going to happen next
Yep.
in terms of how much is actually going to hit them, and talking about that holy trinity before, interest deductibility phasing out, increasing interest rates, and those interest-only periods. The banks are only going to make those harder in the future. They're not going to make them easier. The big question comes, Matt, what should people be doing?
Yeah.
Yeah, look, it's a difficult one, right? So obviously, market rent's really important. So landlords in New Zealand have traditionally been pretty poor at running their portfolio like a business. And we're a soft bunch, by and large, mum and dad investors own the housing stock in New Zealand. The property investor bashing is so misguided. And so these guys, a lot of them care for their tenants. Maybe the tenants have fixed incomes, they know it. It's hard. So first things, obviously, raise your rents. And I expect rents to skyrocket. How? They just cannot, because a lot of the economics of it, a lot of this out-of-pocket cost, when it starts to come through in the next few years, is really going to make a significant difference to people. So that's the first thing. There are exemptions or interest deductibility allowances if you do certain things to in situ property. So the whole premise of the rules is to increase housing stock in New Zealand. So they're basically favouring new builds, people who are going to convert old properties into new properties. So minor dwellings, converting a commercial building into apartments, for example. Things like that will increase your interest deductibility. And actually, one other sneaky little thing from the government is that if you rent your houses to Kāinga, so Housing New Zealand, or a community housing provider, then you can claim interest. So I think that goes to the core of the problem in New Zealand. The government are paying a huge amount of money to accommodate people nationwide, and you've got this group of people that we've already talked about that are providing a lot of this accommodation who are getting hammered. But hey, property investor, we hate you, but you can provide rent back to us, and you have your deduction. So I think therein lies a little bit of the thinking of this government. It's not quite right. When I look at this rule, I've been an accountant for a reasonable amount of time. I'm still a young man. But when I look at it, I go, actually, this is probably the most insane thing I've seen over my 16 years of doing this. It is uneconomic. It is not equitable. It treats two taxpayers in the same situation differently. And what it does is it drives a bit of division between those people who are landlords and those people who are not. And it says, hey, landlord, our government doesn't think that you are entitled to interest deduction because they don't value what you're doing. So, I think it's pretty wishful thinking, but I really hope that a change of government takes this rule away.
That was going to be my question as well. So when I'm talking to people now, they are going, well, National have said that if they do get elected at the end of next year, they will kind of pack the rules and the deductibility will come back. The question is, right, you've got, coming back to it, the phasing out, you've got rising interest rates, you've got those interest-only periods, you've got inflationary pressure. There's a lot of costs, and people going, should I try and hold on? Being dependent on a government election outcome is not a great part of a financial plan.
You don't write those in your plans, do you?
Relying on promises from politicians isn't exactly a great strategy.
I think we can all agree they don't tell the truth all the time. But they would probably frame it differently.
But for those people who are thinking, I'm just going to vote blue and hope for the best, what would you say to those people?
I'd say probably that's not a good strategy. I think that raising your rents, making sure that you manage your debt level. So if you're in a position where you can reduce debt, so traditionally property investors have used debt as their friend, and that's for a very good reason. It provides leverage. Leverage increases your rate of return exponentially. Unfortunately, when the deduction's taken away, whilst debt's still your friend, your rate of return is still increasing from a capital growth perspective. If you are struggling with affordability and you still want to achieve your goals of holding property and having the growth over time, then you might have to pay down a bit of that debt. Or you can, some other options, interest only.
And I think that's a really important point for everybody who's heard this and thought, oh crap, I'm worried about this, what can I do? Have a chat to your broker, your accountant, anybody who can offer you advice on this, because like all of these things, the sooner you start having these discussions and making these adjustments, starting to raise the rent, looking at the structure of the mortgage, how is the property owned? Do you actually have to rent it out to Kāinga or just to save a property in the portfolio? The earlier you start having these discussions, the better. You put your head in the sand, you can end up with an $8,500 tax bill. That's good night, Irene.
Yeah, exactly. And I mean, here at Lighthouse, we do huge amount of strategy work with clients. We don't just go, okay, well, good luck with that.
Yeah.
Have fun. We're thinking about their debt structures. We're thinking about their repayments. Are they raising rents? Is their portfolio optimized from a structure position? Have they talked to a financial advisor? Have they actually got a plan for the next 20 years? So now more than ever in this complex environment, speaking to your broker, speaking to your financial advisor, speaking to your accountant is really important.
Yeah.
And if you're our client, well, pick up the phone.
Yeah.
Awesome. Okay, we'll wrap it up there. Please make sure to give us a subscribe. Please make sure to give us a review, and we'll catch you next week.